Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. As I've stated here for many months now, there are 3 important congestion zones, which in turn have become either important support or zones or resistance areas and impact on the market. Above the current market is the highest and possibly the toughest of these congestion zones between 97.50 to 99.95 area. Although very recently prices have managed to stray above it, only to each time get slapped down. Today we are within the middle zone, in the 93.95 to 96.06 area, at the moment containing the slowly declining mauve medium moving average, currently 95.10. Finally below is a smaller one between 91.83 to 92.56. This last one saw the market push up through it 8 weeks ago, then get capped by the next congestion, the 93.95 to 96.06 area overhead, plus at the time the declining short medium moving average, currently 93.57. And we ended up back down below it again, before 4 weeks ago tackling it once more, and 3 weeks ago pushing up through it. Prices then traversed the free area up to the 97.50 to 99.95 area, where we tried pushing even higher for nearly 2 weeks. However, last week prices started their journey back down, pushing below and out of the 97.50 to 99.95 congestion area and into the 93.95 to 96.06 congestion zone. Today, prices have seemingly attempted a major decision. They have pushed down below the dark blue lower time, currently at 96.44, of the breach but seemingly repaired early August to early September bullish Andrews picture, which I drew 4 weeks ago. And I said at the time, and I quote, "I am not in love with this pattern, even if it is the first bullish pattern of note I've drawn for quite a while. I'm quite prepared to finesse this into a shallow bullish shift picture or even retire it completely, but for now it is doing its job of showing a nascent bullish angle of attack higher." Well, today it's starting to fail its job unless it repairs itself quickly. And at the moment, the one thing I'd say in its favour is it's being supported at 95.10 medium moving average, the mauve medium moving average at the moment, so it may be repaired. Well, unless it does that quickly, repairs itself quickly, then I will have to retire this bullish pattern and rely on the three congestion bands again. Though there is one other difference, a major one, between now and what I said 4 weeks ago. This market no longer has the option to finesse itself into a shallower bullish shift pitchfork. That opportunity no longer exists. LME 3-month aluminium. There is still a lot going here on this daily chart. The move higher over March, April, May, and I suppose even the most recent one from early August originates back to late February, with the market breaking higher from a diamond pattern type formed back then between late October 2023 to late February 2024. Now please remember this, as it's the congestion generated by this diamond pattern on the wide between 2100 to 2400, but really between 2156 to 2297. That caused the very recent rise since late July, though obviously not the original pattern itself. Okay, let's go back a bit. The decline from late May to late July was stopped by the extension to the neckline, currently at 2218, of the June to July 2023 reverse head and shoulders neckline pattern. From this base, prices started building and experimenting upwards from the same price zone as the earlier diamond bottom pattern, roughly between 2400 to 2100. In the process, over early to middle August, the market constructed a small ascending triangle pattern, reaching the primary and secondary targets on the upside and pushing up through some significant resistances, now turned into supports. The nearby notable ones were and are the congestion zone from mid-June to mid-July, between roughly 2485 to 2563, containing the key levels at 2485, 2508 and 2563, plus the bright red middle time, currently at 2555, of the mid-December to 2023 to late July this year, shallowly rising bullish shift pitchfork. I also drew 4 weeks ago a shallow bullish shift pitchfork for the late July to early September move, and I said at the time, and I quote, "This last one, I'm happy to finesse or even retire as the market demands," end of quote. While the market originally demanded I finesse this to a more acute bullish Andrews pitchfork, which is highlighted in bright green on my daily chart. And this has, more or less, worked until this past week, when it was breached and then repaired, and again till today, when we seemingly have a more serious breach of the bright green lower time, which is currently at 25.80. When looking at this market's actions, I said 2 weeks ago, and I quote, "All this is making me think that just perhaps the market could do with a bit of a rest right now before any fresh attempt higher. I have nothing behind this other than a fear of an overextended market not being able to generate energy for any further attempts higher." End of quote. Well, my fear of an overextended market has been borne true as we have dropped last week all the way down to the December 2021 low at 25.81 and close to the bright red middle time. So it's currently at 25.55 before pulling upwards and then turning back down again this week. All this activity has left behind one pattern, a September to date ascending wedge pattern highlighted in dark blue on my daily chart. This pattern left a primary target in the 25.85 zone, which was reached last week, and a secondary hardest to reach target X1 down in the 24.55 zone. As I've already indicated in attempting these, the market only pushed down through some significant congestion supports, but also the bright green lower time and towards the flatlining medium moving average currently at 24.77, and challenged the significant 50% Fibonacci line of the December 23 to May 24 move at 24.54. Last week I added, and I quote, "This will be an interesting contest to watch," end of quote. This week I suspect we're about to enter that contest. LME 3-month lead. There are a number of significant features on this daily chart. The first I'd like to mention is the immediate overhead wide band of congestion originating from April between roughly 21.35 to 21.86. A congestion area that showed itself at the peak 7 weeks ago and again over the start of October. This area contains the 50% Fibonacci line of the March 2020 to March 22 move at 21.35. The nearby gold long moving average, well, it's not highlighted anymore, but nearby long moving average currently at 21.25. It's still there. And edging out of it, the mauve highlighted declining medium moving average currently 21.12. The next is the late July to late August reverse head and shoulders pattern. It's far from a pretty one, and I'm loath to even mention it, but it does exist. And that rise peaking 6 weeks ago was all it could achieve. But it did lead to another pattern, which I'll discuss shortly. We also had well below, Fibonacci-based congestion and otherwise between 1994 to 2002, followed by the June 23 low at 1976, which looked, how shall I put it, less interesting. And then the 2024 low in August at 1917, which I suspect is a function of the nearby 2021 low at 1908. There's also a neckline extension currently at 1944 of the July 23 to February 24 head and shoulders continuation pattern. Now the reason I mention these supports below is that they contributed in eroding the decline we saw in early to mid-September enough that it was stopped and turned back upwards and brought about one, possibly two bullish patterns. Originally had a bright red early August to early September bullish Andrews pitchfork. However, since last week I finessed this to a shallower bright red early August to early September bullish shift pitchfork. The market is right now in between the middle tie and above, currently at 2073. It's actually on that middle tie and above at the moment at 2073. And we have below the lower time, which is currently at 1977, which has been trying towards today. The second pattern, and here I'll quote from last week's commentary, when I said, and I quote, is the almost ready, though not yet triggered, mid-July to date double bottom. This has a neckline in the 21.35 to 21.40 area, and as I previously stated, it has not been triggered, but doesn't stop me from laying out some potentials topside should it happen to be so, for next time. Thus a primary potential, not a target yet, but a primary potential would be up in the 22.73 area, with a secondary, harder to reach potential up in the 23.24 area. All it would need to kill these two would be the market to just go sideways and open up the possibility of a shallower bearish shift pitchfork and even a triple bottom, so watch carefully, end of quote. Well, as you can see, we have not gone sideways, but instead actively headed lower. and so this pattern now is on hold. That just leaves the one new pattern that has or was being set up last week, which I clearly detailed as a possible weekly key reversal. Well, last week turned out to be a weekly key reversal down, and this week prices are following on from this pattern. We are now testing the January 2020 high at 2039 and seemingly heading towards the supports at 2021, 2001, 2002, 2001 to 2002, 1994 and the June 23 low at 1976, near where the bright red lower time is staying, currently at 1977. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.